This man got $400 and turned it into $200 million. Intrigued by commodity trading in the late 1960s, he worked as a young runner on the exchange floor, working for minimum wage. In the summer of 1970, he decided to venture onto trading on his own and borrowed $1,600 from his family. He bought a seat on the Mid-America Exchange, a minor league exchange, trading smaller versions of contracts from major exchanges. It was well suited for a beginner trader with little capital. After purchasing the seat for $1,200, he only had $400 left to trade. And that's where the story begins. This man's name is Richard Dennis, and he went on from trading his little capital of $400 to an estimated fortune of $200 million. Before we get into the highlights, it's important to note that Dennis had major drawbacks and setbacks during his trading career, including a downturn in the late 1987 to early 1988 period. Several public funds managed by Dennis suffered huge losses during the specified period, leading to a 50% loss cutoff point, and Dennis's personal trading account also experienced significant losses. Dennis acknowledged the losses in a letter to his investors, noting that the results parallel losses in his personal trading account as well. Despite these setbacks, Dennis has been exceptionally profitable and successful over his trading career, trading commodities, and has maintained his composure through his confidence in trading, his strategy, and long-term perspective. You have to learn to accept the losses and see them as a cost of doing business. Just like the necessity of pain and struggle to become great at anything in life, losses are inevitable when you're trading. And so learning to manage them is a key principle to any profitable trader. Once you have a strategy that you're confident in, you must take a disciplined approach in sticking to it trade after trade, day after day, month after month, regardless of the temporary outcome. Dennis doesn't fit the stereotypical image of a centimillionaire, as he's known for his low spending lifestyle. His only real extravagance is his political and charitable contributions. Dennis's political views diverge from the popular image from the very rich. He's also the founder of the Roosevelt Center for American Policy Studies, which is a liberal think tank. He supports the concept of higher tax rates for wealthy Americans. It seems that many successful and wealthy people hardly put any efforts into materialistic luxuries or possessions. I personally don't have anything against expensive things, and I don't judge people on what they do with their own money. It's their money, and they should be free to do whatever they want with their hard-earned money. But it's undoubtedly true and better to derive your worth not from materialistic possessions or spendings, but from your actions. Plus, can we all just be honest? Those Richard Mille watches look like G-Shocks for adults, and it's crazy and almost comical how much these colorful bracelets go for. I mean, $500,000 for a colorful bracelet and a watch seems absurd to me, but to each their own. Dennis is considered one of the foremost trading legends in his time, with others in the field acknowledging him with the phrase, "I'm not even in his league." So graduating high school and landing a minimum wage job on the floor, Richard Dennis was introduced to trading and spent his minimum wage salary trading on the floor and then losing it in an hour, repeating that cycle over and over again. However, he states that his tuition to getting into the game was a small and minimal one. I recommend anyone starting out to trade with as little contracts as possible, even one, because in the beginning, you will lose, and it's just the cost of doing business and the price you have to pay to learn the game. Even if you do get lucky and start winning in your first few trades, you won't know how to keep the money because you don't have a strategy that you've backtested and are confident in because you're just starting out. When he was just 20 years old in 1968 and 1969, he was trading with his father, who was filling in the orders for him in the ring while he signaled the trades to him. At this time, he was still losing capital and was losing a couple thousands of dollars. He states that it's actually a bad thing that certain traders or beginner traders become profitable way in the beginning because they become biased to one side or the other. If they make their first big trade going long, they have a higher probability of being more biased to the long side. Without being objective to either the bull or bear side, their trading eventually goes askew because the markets change. Unless you're scalping your trades, which means you're getting in and out within seconds or minutes, I think this definitely rings true. If you're swinging your trades for days or months, being wrong in the overall direction of the trend can be detrimental to you. Personally, as a technical scalper, I don't care about the news, and I also don't care about which direction the market wants to go. I let the price action dictate my actions and react to what it shows me. There are definitely traders that have more of a bias to one side or the other and are either more comfortable towards the long side or the short side, which can definitely work as well. Thus, I guess you can say it just depends on the trader and their personality and which suits them best. With a need to succeed, but with no confidence, he made many mistakes trading mini contracts on the Mid-America exchange. Although most traders don't see success or profitability in their first year, Dennis was able to do so and learn enough in his first year because of concepts such as going with the trend and cutting your losses quickly. In the beginning of turning his $400 into $2,000, he liked to buy at the close of a strong Friday and hold it over the weekend, ultimately going with the trend. Before the summer of 1970, in which he was signing up for grad school, he made $3,000 from his $400. Not a bad start. He then went to New Orleans, not even lasting for a week, and then came back to Chicago, deciding to trade as a full-time commodity trader. So during his first year when he had $3,000, he remembers losing $300 on one trade and then reversing his position and losing again, making him losing $600. Then he reversed his trade again and lost another $300, losing $1,000 or about 1/3 of his capital. So he learned early in his career that when you have a considerable loss, it's best to just get out of the market and clear your head before executing another trade. It was a great lesson for Dennis, as he avoided trying to make back his loss or trying to double up to recoup his losses, as he realized that trading after a loss is way more emotional than the usual trades he puts on. He states that you must keep losses minimal and small and have enough capital so that when opportunities are abundant, you put on risk and take advantage of those opportunities. Those are the kinds of trades that can make you a lot of money in a relatively short amount of time, and so you must have capital to be able to do so. But when you're taking substantial losses, not only do you have the capital to not trade, but you also don't have the emotional stability to take on an A+ setup because of all the other losses that are affecting you emotionally. There's a 4-letter word that describes this: tilt. When you lose, you may notice your emotions start to get riled up and you want to immediately make that loss back. Throwing strategy and discipline out the window, you trade on complete tilt trying to make that loss back until you lose way more than you expected and way more than you were supposed to. This is also called revenge trading, and this has happened to every seasoned trader. Does this sound familiar to you? The best thing you can do is learn from the loss and make sure to never trade with the intention of making a loss back. You should only be taking a trade when the setup presents itself to you. There are just those certain days, whether it's from your intuition, what the market is telling you, or what the news is telling you, where things just make sense. And when those kind of days come to you, you must swoop down like a vulture and go for the jugular, putting more risk on those trades to maximize your profits from your best setups and what I call easy money setups. In 1973, the soybean market was in a strong uptrend, and Dennis was able to capitalize on this by scalping in and out of the position, all in direction of the trend, stating that those were his high probability trades. It was apparently a very strong market back then, as sometimes it would go limit up for 10-15 days in a row. In 1977, Dennis became a floor trader, and in 1978, he decided to trade from his office to be able to trade from multiple markets, such as the future markets in currencies, gold, or interest rates. 1973 was a strong market, but Dennis states that 1978, during his transition year, wasn't a good year to trade at all, as he compounded losses on tilt during the specified period. What he learned from that year was that he had an edge in being able to scalp in and out of trades while being on the floor, with little and tight risk. When he was off the floor, he lost that edge when he placed orders, and also by losing the subconscious indicators of price movement while being on the floor and looking at the screens, and from pit traders who always seem to be wrong, in which you can take the opposite direction and make money. I don't trade commodities or other markets like Forex, but I trade mega cap stocks like Nvidia and Tesla. And when the Nasdaq or ES is strongly trending to the upside or downside, those are the best days to trade. It doesn't happen all the time, but when it does, it's important to accurately analyze these situations and take the fullest advantage of a strong trend and clean price action. With everything being computerized and digital nowadays, I think that the markets have definitely changed so that you can still have an edge as a retail trader. Brokerages such as Thinkorswim or Interactive Brokers fill you in pretty quickly so that you can scalp with good entries and exits. In 1984 and 1985, Dennis and his high school friend decided to start an intellectual experiment to see whether if beginner traders can be trained with good principles and strategies to become successful, or if trading was simply based on subjectivity, intuitiveness, and almost a genetic predisposition. Screening 1,000 applications, interviewing 40 people, and then picking 10 people, he instilled a set of rules and importance of consistency and discipline into them, while also leaving them onto their own discretion to trade based on their own feeling or judgment. After 2 weeks of teaching them, he had the group trade for a month and journal why they took their trades. In 1985, they trained another 13 people for just 1 week. So between the 2 years, with 23 traders in total, they dropped 3, and the other 20 people averaged about 100% gains every year, all starting out with $100,000 each. This strengthened Dennis's belief that luck absolutely played zero role in successful trading, and making money in this business over the long term is purely statistical. Although one trade may be purely luck, over the long run, statistics dominates the results, as you have to look at the outcome in terms of years and not days or weeks. If you look at any profitable trader and look at their track record, their ability to pull out money from the market month after month, year after year, is no coincidence. It's based on a logical approach to trading, risk managing, with an overall strategic game plan. The fact that Dennis took 20 people and was able to make them average about 100% gains proves that trading successfully is not luck, but actually a skill that can be learned. If you're not approaching the market, or really any kind of business, with a systematic approach, there's no way to reflect and learn from your mistakes, because you're making every action and execution based on your wits or feeling. You should always be looking at why you took a trade, how you could have gotten better, and document every aspect of the trade after the market closes. If you don't know for certain if you should get into a trade or not, you probably shouldn't. And if you find yourself entering a trade with no confidence or hesitation, you should exit, reanalyze the situation, and enter again if the setup is there. Dennis states that he primarily likes to trade with the trend, and that it's very difficult to be profitable making counter trend plays, although he has done it before. For instance, he shorted sugar at 60 cents, and in November 1974, sugar plummeted from a high of 66 cents to 12 cents only 7 months later. He says that you should never be biased toward any direction of a market in the absence of anything. For instance, let's say a stock is going up. Just because you think that the stock can't go any higher, you can't short it on the premise of that thesis, because the market is really prone to do anything. You must expect the unexpected and expect the extreme. The unexpected and impossible happens every now and then. Therefore, if your thesis is wrong by what the chart is telling you, and based on the price action of the chart, you need to get out at your set stop loss. Never be too fixated or overconfident in your thesis or trade. Whether or not you believe that the market is efficient or inefficient in its valuation, if your price action is telling you that it hits your stop loss and that you're wrong on your thesis, you must cut your loss quickly and get out of the position. You can always re-enter the trade if your thesis proves to be correct, because that's better than risking the possibility of holding it and experiencing a loss bigger than expected. Richard goes on to say that with $120 million of customer funds, he's very diversified in his trading and has different strategies, that liquidity issues aren't a problem as of the time he was being interviewed. Richard Dennis is a swing trader, and he states that if you have a loss after a week or two, the trade is usually wrong. If it's still been a significant amount of time and it's break even, it's usually still wrong. Always have a minimum risk point when getting into a trade, and be disciplined in cutting that loss at that point or quicker if possible. Every time I enter a trade, I know non-negotiably when to get out when a certain stock price hits my stop loss. Because when it hits that stop loss or that price, that's when my thesis is wrong. Letting that trade ride will have you experiencing larger losses than your winners, making it very hard to be profitable and successful. From my personal experience as a scalper, my trades usually work in my direction and in my favor immediately. And if it doesn't, I'm a little more skeptical, and I will reduce my position if it's stagnating or hesitating for too long. When I experience a big drawdown immediately when I enter a position or a trade, majority of the times I'm wrong, and I need to get out immediately and cut my loss quickly so that I don't experience a big drawdown. Richard Dennis was self-taught, and there was very little literature on the topic of trading itself, during that time in the 1960s and 1970s. His key trading strategy is simply catching the major market trend consistently and riding that along. Easier said than done though. The real question is when he exactly enters, if he should enter earlier or later depending on the market's reaction to news, or if it's going against his thesis, entering when the trend is better defined. Without even looking at the market name, he states that he can trade in any market with his system, as he has a pattern that is universal with every market except the stock market. Richard Dennis states that individual stocks have more price fluctuations and is less prone to trending than commodities because there isn't as much fundamental information on stocks compared to commodities in order to create sufficient trends. Plus, there aren't as many commodities as there are stocks, and so it's easier for commodities to trend. When he experiences a losing streak, he usually likes to take a day or two off, clear his head, and then get back into the market. When asked about the biggest fallacies of the market, he states that the biggest fallacy about the markets is that the market is supposed to make sense and that technical factors aren't as important as fundamental factors. To first address his position on stocks versus commodities, I think that it rings true, and as a trader who primarily trades options with stocks, I'm not swing trading them or holding them for days or weeks, and I'm mainly scalping them. And so it doesn't matter whether it trends or not for me. Yeah, it's good to know which trend the stock and the market is going, but as a scalper, it doesn't really matter. And to address the second point, technicals for me is more important than the fundamentals. Because no matter how bullish or bearish a fundamental news is, let's say you enter the trade based on fundamentals and it doesn't work out in your favor because the charts are telling you so. At that point, when you enter a trade, you know your set stop loss, and so when it hits that stop, you need to respect it and get out. Respecting the technicals more, no matter how confident you are in your fundamental thesis. Whether the market makes sense or not to you, the name of the game is managing your risk and cutting losses quickly. And so if the price action is telling you to get out and is telling you that your stock is moving unfavorably against you, you need to cut off your loss quickly and immediately instead of holding and hoping that your fundamental news thesis is going to revert back. In April 1968, Dennis ceased his trading of public funds in which he was managing other investors' money. When his funds were 49% down, he liquidated his positions because of the drawdown. He says that he doesn't regret the trades, but he states that he would have cut the losses more quickly. On October 20th, 1987, he was short the euro dollar with a stop loss of 40 to 50 points above his entry, but the market opened 240 points higher that day, blowing 190 points unavoidably. Dennis speaks about his 49% drawdown on more than $100 million of customer funds unemotionally, and when asked how he does so, he states that it's totally counterproductive to view it with so much emotion. There's more to life than trading, and so to be emotionally deflated because of a loss leads to a loss of confidence that isn't beneficial either in the short term or long term. You should focus on the long term of the next 1,000 trades instead of the short term fluctuations and setbacks. And it's important to not get so wrapped up in your big wins as well. If you feel too good about winning, then you'll feel too bad about losing. Instead, it's better to be stoic and composed either way in either of the outcomes. The advice Dennis gives on how to stay calm during periods of losses is to look at it like playing golf. You may take a bad shot and throw your club down, but the best way to play is to forget the past and leave it in the past and focus on the next play and on your next shot with 100% focus and attention on the ball at play. Everyone is human, which means that we all have emotions from the primitive side of our brain or the limbic system. It's impossible to suppress it and just act like a robot. And the best thing is to learn how to cope better and reorient yourself better. Don't become so focused on your P&L or your profits and losses, but look at the playbook and your execution and analyze what you did wrong or right. By focusing on the process of trading itself, you'll eventually make more money as a result of that. That's why managing your psychology in trading is just as important as your strategy, because executing your trade without hesitation requires discipline along with your back-tested theory. With more prevalence in computerized trend-following trading systems in the past few years, false breakouts were more frequent than before, as that's what happens when more people do the same thing. It's a universal principle that mimicking the herd results in a regression to the mean, in which your results become average by definition and by law. It used to be that most people didn't follow the trends as they thought a price was too low or too high to enter in direction of the trend, prompting them to take more trades that are counter trends. But with more people entering now with the trend, it causes more people to take profits and cause the trend to stop and reverse, causing more false breakouts. When asked about economic growth projections, inflation, and the dollar, Dennis says he keeps them in mind while trading, but doesn't use it as reasons to enter a trade. Trading is like betting on independent rolls of the dice that you think have an edge in your favor based on your statistics or news. Rigid long-term beliefs based on fundamental news such as inflation or economic growth projections can lead you to missing profit opportunities, something you definitely want to avoid. Once again, don't be too biased in one direction of a trend, but be open-minded and reactive to what the market is telling you. Look at the price action and let that action dictate your action and what the market is telling you to do. In life, it's good to be proactive and action-oriented, such as when you're getting a girl. You want to be active and go up to her, ask her her name, what she does, and get to know her. Well, trading the market is just the opposite. You want to be reactive and try to see what the market is telling you and then react accordingly. In 1988, when the interview was recorded, Dennis foresaw a budget deficit problem where he predicted the government will cause inflation by trying to avoid a recession and quantitatively easing the economy. He stated that the deficit problem can't continue forever and that it's like a house full of termites. You don't notice them until one day they gnaw a big chunk of the foundation away, collapsing your house. There's too much debt that the government is taking on, and he proposes that the government needs to balance its budgets, just like the states. 35 years later, Dennis actually proved to be correct in his thesis and was ahead of his time. Our gross federal debt is higher than ever before, sitting at more than $33 trillion. This is definitely a threat to our economic future, and politics does play a big role. We'll see with the upcoming election and next president on what they'll decide to do to manage this, because Dennis was right. This can't continue to go on forever, and it's the biggest termite gnawing at the foundation of our nation's economy. When asked about giving advice to a novice trader, he recommends trading small, learning from your losses, and not being swayed by the day-to-day P&L fluctuations. Focus on the strategy, executions, process, and not the randomness of any single trade outcome. He says that one of the worst mistakes that a trader can make is to miss a big profit opportunity, or what I call an A+ setup, and he estimates that 95% of his profits came only from 5% of his trades. He stresses the importance of not blowing up, sizing in appropriately, and managing your risk to be able to put on a trade and take advantage when an opportunity presents itself. All in all, Richard Dennis averaged an annualized compound return of 25%, and each $1,000 invested with him would have been worth $3,833 at the end of it. It would have been double if he didn't have the big drawback in his last year. It just goes to show that even when trading more than 20 years, losses are still inevitable, and taking losses is just a part of the game. You only have to get better at handling it and not trying to avoid it. Trading is psychologically and mentally tiring, which is why he probably chose to quit cold turkey and leave trading for good, just to live life. Making money is cool and all, but it's not the end-all be-all. And if it is for you, I say it isn't a life well lived and experienced. The point of making money is to buy your time back and then waste it on your own terms with absolutely no sense of it at all.